There we go.
We're on. We are on now. Look at that. We've been. So it's been a minute, hasn't it?
It has, and for both of us, a much needed, and it's debatable. It's debatable or not whether it was deserved, but some time off, and it's been it was excellent for me. And we talked a little bit about it before we jumped on. It sounds like yours was equally as relaxing as mine.
Yes, I can say without a doubt, my dear wife deserved a little
For sure.
time. So she, yeah, we'll see how she is. It was good. It was a good trip, good break. We're back. So I guess we should say welcome back to the Creative Real Estate Investing Mastery Podcast. So we're back and better than ever, brother. How are you doing today, Mr. Coffman?
Well, I don't have much to complain about, so I'll just keep it to a minimum. Everybody knows that I've got to get out my complaints right off the bat, because once it's out, it's no longer swirling around in my head. So, but no, we got back from our little vacation. Super, super relaxing. I mean, it was just it's over the past probably, I don't know, I'd say five-ish years. It was the best trip that we've had in a long time. It was so great.
Excellent.
As soon as I got back, literally the day after I got back, I felt this little tickle in my throat. I was like, "Oh no!" And so I ended up getting this little cold. Of course, we stayed way out in the sticks, but we visited we visited a town that, it's a pretty touristy town. So I imagine I picked up something from there early on, but I'm not mad about it. I do have, so if anybody's wondering, I do have a little, you can see how much I've been blowing my nose. It's like,
yes, little red around the edges there.
I feel like the high schooler with the big zit on their forehead right
now. Yes, indeed.
But no, other than that, man, we just had such a great time. It was so amazing. But, and I hear your stories actually got me a little intrigued about, because, we have different visions for what I think a vacation is. For the most part, we're very different from, what you seek out is very different from what I do. But you really had me kind of in a little dream state this morning, telling me about your vacation. So
yeah, well, I'm more of a beach guy. I don't mind the mountains and things like that, but I don't think I work out a lot, like 500 plus workouts in a year and all that too. But I'm not really a hiking kind of guy like you are through this. I mean, I don't mind that, but not like every day or for 50 miles in a week or something like that. I'd rather be swimming in the resort pool or in the ocean or something like that. Yeah.
Yeah. Well, what good is working out if you can't put it to use?
Well, that's true. I don't remember that. But like I said, a little bit, but not like you. Like you love that hiking stuff, which is good. Like I don't mind it sometimes, but I'm a much smaller dose type of guy with that stuff.
I get it. Yeah. But other than that, man, I'm ready to get back into things, and been I don't know, we haven't caught up in a while, so it's good to be back. Good to be back on doing this. So this is certainly this is a love-hate thing for me, the podcast thing, to be honest with you, because I'll be like Thursday night, like, oh, I got to get up and come up with all this stuff. But once we get rolling here, it really just kind of rolls off the tongue. It becomes really easy, and it's just a conversation. So I guess that's probably the biggest source of it. I'm an introvert, and having a conversation sometimes
You're an introvert, yes.
it's not my thing sometimes. But I always tell people, you know, you're an introvert. Like if you can get me there, I'll probably be the life of the party. But it's the getting me there and getting me in front of people that can be a little bit of a challenge for me.
That's interesting. And can we, before we get going today on the thing, can we do some? We don't do this enough, but can we do some shout outs to our Set to Empire? We're just gonna call them deal partners in there too. So can we give a shout out to Tyler in Florida, who just
Absolutely.
found an end buyer on his first sub two deal in the great state of Florida?
Yep.
So we just want to say congratulations to that. Also, too, we've got no students like Laura's killing it. She's got a bunch of stuff under contract and is getting things ready. So solar finance deals, right? Creative stuff. So that's good. And then Craig too. Craig's closing on a probate deal, right? Hopefully today and all that. And he's just been steadily getting some properties.
Yeah, man. That's the
Not all of it's been creative. Some of it's been
yeah.
more straight, rental or a fix and flip or whatever. But he's been very steadily knocking it out, man.
Yeah, and Craig in particular, uh, he's gonna win the long game here
Mm-hmm.
because he's not the anxious type. He's very methodical, and there's definitely all this stuff for him was really kind of a learning curve, but he's always looking. He's always finding these deals, and it's amazing to see. I mean, um, he's not what you talked about Tyler. I would consider Tyler like a um, sort of like you, like the short bursts, like boom, but and then he just gets it done and nails it. Where Craig is kind of the slow and steady. I do think that Craig. I do believe that Craig is going to be. He'll be in this game for a long time if he continues with his with what with the actions that he's taken now. So
Yep. Yeah,
slow
that's
and
good.
steady.
And then Kim, we're doing a deal partner deal the that Baldwin townhouse flip we're doing has not panned out as great as we would have hoped, but we're getting set to look at some more properties and get back in the game on that. So
Yep.
we're it's all good. I mean, things are flowing, brother. Things are flowing.
Yeah, we were just a few weeks ago. We were talking about how we were needing these vacations. We were stressed out because we had taken on a lot, and then just like overnight, boom! All of a sudden, we had you know buyers coming out of the woodwork. Uh,
Yep.
we managed to dispo at least two properties, maybe three, right?
Yep.
Yeah,
Yep. Except for that townhouse. That's the only one we have left now.
yeah,
We just put
yeah,
all the others. Yep. Yep.
yeah.
And
It's
all of
just
a sudden, you're right. It was like bam, bam, bam. We got it.
yep,
Yep.
yep. So yeah. Anyway, I'm gonna say it this time. Happy Friday Fun Day.
That is right. Happy Friday Fun Day. That's right. We're ready to go. So, with all that said and the shout outs done, too, what is our podcast topic today, Mr. Kaufman?
We're gonna change it up a little bit today. We don't normally get into. I mean, sometimes we do, but we don't normally get into policy types of things all that much. Um, but as everyone should be aware of now, the Trump administration has introduced um, the idea of these 50-year mortgages. Um, Now, if we also combine that with the fact that we have now Fannie has just completely wiped out a minimum credit score requirement, not lowered it or
Removed it.
relaxed it. They removed it
Yes.
completely.
Yes.
And so, I get out here on in the Facebooks and all the Instagrams, and it's doom and gloom, and oh my gosh, I can't believe. And half of me believes that it's just half the country that hates the Trump administration, but the other half is I get there's a lot of doom and gloom coming from them as well. And I think what we want to talk about today, we want to break down real actual. I would like to break down real actual numbers. I would like to talk about um, what this means. First of all, what this actually means for not just real estate investors, but on the creative side. because there is some upside to this, considering the investor's willingness or um, acceptance of risk. There can be an upside to this, and you know me, I'm always a glass half full type of dude. Like I always try and look at the bright side of things, and sometimes sometimes at my detriment. But I do like to. I don't know. I kind of, without sounding hoity-toity, I guess. I've always taken this approach, and it's a blessing and a curse. But I've always taken this approach of, when you see people going one way, you've got to look the other way. You've got to look at alternative ways of, uh, not just going with a crowd. Always got to look at alternative ways to make these things, or to adapt to these changes, these constant changes that we deal with in this industry. So this is that case. When I first heard about a 50-year mortgage, I was like, that is insane. That is nuts. And admittedly, like, I don't know if anxious is the right word, but I felt like a little bit of pressure, like, oh my gosh, 50 years, that's, and we talked a little bit before we got on here, and I essentially, I said, that's basically like renting, you know. Um, and we'll get into that here as we get started, but yeah, that's what we're going to talk about. We're going to talk about this, what I think is a the beginnings of a little storm of brewing. I think there's definitely going to be some negatives to this, and but you can always draw a positive out of something. I really do believe that, and we're going to talk about that.
So can we go back a step and
Yep.
and just talk a little bit about some factors around this, right? And it's not so much about the people who are floating the ideas, it's the ideas themselves that we want to talk about. So if we go back, why would anybody, whether it's the Trump administration or anybody, throw out a 50-year mortgage, right? Why would we not go from 30 to 40, right? 40-year mortgages actually exist now, by the way. You
Yep.
can actually get those now. It's just not widely advertised. But you can actually do that now. You can ask your bank to say, would you go 40 years out on that? But going out to 50 years, why would anybody even say that? Well, it's because people can't afford anything anymore because of the runaway rampant inflation that existed under the previous administration. Why did that inflation exist? Well, once, what competent ass clowns are in the country, that's number one. Number two is because you cannot print 80% of all money that the United States has ever had in circulation. 80%, this is a fact. 80% of the actual bills that are in existence today were printed since 2020. What happened in 2020? The pandemic. We printed money and print money and print money. You cannot continue to do that. Inflation happens.
Yeah.
It's a rule. It's like a universal law. It's like a physical law. You can't continue to do that and you don't have inflation. Now, can you do other things to help control the inflation? Sure, you can. None of that was done in the previous administration. So the inflation was worse than it should have been. Okay. So we have this runaway inflation that is out there. And so people can't afford it, right? Like the normal working people, right? Say the middle class, there's pretty much no middle class in America anymore, by the way, right?
Mm-hmm.
But whatever we call the middle class anymore, whatever's left of it, can't afford like to make all these payments. So that's the pressure that's being put out there. And he says, well, how can we help people keep money in their pocket every month? Well, you can have a mortgage be more than 30 years, 40 years, and then float the 50 years. So that's why that was floated, right? It wasn't just said off the cuff. It's like, okay, we're trying to get inflation controlled back down. And I think inflation was like year over year, wasn't it like 2 or 3%?
2.9. Yeah.
Yeah, like much better than the 10 to 12% it was for the previous 4 years, right? So that's coming back down into control. But to help alleviate things quicker for people, what can you do? A 50-year mortgage. Now, can I just say a couple of things about this doom and gloom and all that stuff about the 50-year mortgage? Folks, don't panic. All right. Everybody, like on a standard, with very few exceptions, like a standard traditional 30-year note that you get now, or 40-year note that you, or 15-year note, whatever it is that you get now from a bank, a traditional bank, there is no prepayment penalty. So you can make additional payments. You can pay it off as fast as you want to pay it off. There's no reason you can't make additional payments. If you make just 4 extra payments, principal only payments a year, you cut off like 10 to 15 years off your term, depending on what all your specific terms are in there. Like, it's amazing how fast that comes down. Nothing stopping you from making additional payments. Number one. Number two is, if you don't want to have a 50-year loan, don't get a 50-year loan. Just because it's available doesn't mean you have to have it, right? And the other thing is, so now we switch from the 50-year, if you've noticed just recently, to portability, so that you can get a mortgage term and take it with you from property to property, like as a primary residence. Take it with you property to property. Now that's gold, brother.
That is gold.
That is really
That
where
is
where it's at.
yeah,
Yep.
that is an excellent, excellent. I'm not sure if that's ever been. Was that has
I've
that
never
ever been
heard
a
of it.
policy before? Has that ever been?
I've never heard it before,
Yeah,
because it's interesting. And there has to be terms in there, like we put this in our notes. We're private lenders, right? And we put this in our notes that we can substitute the collateral, but it has to be of equal or greater value. So I'm sure that there's going to be all those caveats in there, like you can't downsize with a lot, which a lot of people do, because you typically downsize into a lower property of lower cost, right? It's smaller, it's lower cost. And so how can you take your mortgage, because the mortgage is backed by the asset.
yeah,
So if your asset's worth $300,000, but you're going into a $200,000 property, like something, yeah,
yeah.
like
You're gonna
that's
have to
probably
come
not
with
going to
some
be
cash.
allowed. You know what I mean? So yeah,
Yeah. Still,
yeah,
nevertheless, I agree with you. It's a golden opportunity. I mean, it is. It's a. To my knowledge, like I said, it's never happened before. But I do
yep.
want to touch on what you just said, um, regarding the 50-year. Uh, and you guys are going to have to excuse me. I might have cut my mic off from time to time. So just a heads up. But if we if we look at the 50-year mortgage like we look at a car loan, we've had this same thing: runaway inflation, ever expanding costs to manufacture cars. I mean, the average pickup truck right now, brand new pickup truck, is like the average cost one was like $57,000, which is nuts. I mean, I never thought I'd see that in my lifetime, but here we are. But what is the when someone goes into to buy a new car or truck or whatever? Generally speaking, especially if they're like middle class folks, certainly lower class folks, their number one concern. What is their number one concern? They don't even care about interest rates. Their number one concern is, what is my monthly payment going
Yep.
to be?
What's the payment I can afford, right?
And so now we've transitioned that into real estate. Where it's kind of removed this, um, where the bottom line is, and this is due. I mean, this is 100% due to that inflation, because I mean, I don't know where this generation. I don't know. I just can't. I can't even imagine having to be a 22, 23, up to 30-year-old person trying to buy a home these days. It is insane. It's just the prices are insane. And so while I think this 50-year mortgage, generally speaking, is probably not good for a borrower, it's probably not the best option for them. It should be an option. I do believe that. Um, it's probably not the best option. I think that we have to stand back and consider where we're at in our economy right now, across the board. I mean, people tend to think that uh, somehow these homes are appreciating in value, and that they're somehow magically overnight uh, they're now worth more than they were the previous year, and it's just I probably don't need to say this at all, but it has nothing to do with increased value. It has to do with decreased value in the dollar. Every single dollar that is printed obviously makes the one that was printed prior to that worth even less. And so we've got, like, to your point, we've just got all of this capital in the economy, and we've got to get it under control. We've somehow and 50-year mortgages is not going to fix that
No.
by any means. I mean, really, from my point of view, and certainly not to be political, but from my point of view, the government spending is the absolute root of all of this, all evil. It is the most evil thing on the planet. We're all paying for it. When a carton of eggs now costs you, $7, $8, $10, depending on the quality of egg, of course.
Yes.
Then you've got problems. So I think what I want to do. I'm not sure if we're ready for this or not. I don't have my notes up, but I would actually like to run through while we were waiting for this to start. I actually ran through some numbers here,
Yep.
and what I'd like to do is I want to give a hypothetical scenario, and I want to talk about the difference in quote savings, both for I want to talk about savings for the borrower and how we can incorporate this new 50-year thing into creative financing.
Yes.
So what I did was I've talked before about a loan constant. And if you don't know what a loan constant is, a loan constant shows the actual cost of the money on the loan that you are servicing, and it's represented in a percentage. Okay, so I have a little scenario here that I've written down. This is the difference between a 30-year mortgage and a 50-year mortgage. The little caveat here is that, oh, by the way, the loan amount on this is going to be $250,000.
250. Yeah, we'll use that as our baseline amount.
That's the baseline. So the caveat here is that we've got a break in the percentage for the if you so let me back up. For a 15-year mortgage, right now you can get a 15-year mortgage at 5.5%. A 30-year, if you opt for a 30-year mortgage, that mortgage is going to be right around 6%, maybe just slightly above on average today, right now. So we have to assume that if you go out and get a 50-year mortgage, your interest rate's probably going to be bumped up. And I think you and I talked about this a little bit. I think that average is probably going to be somewhere around 6.5.
Yeah, like another half point, like a half point between each level.
Right.
Yeah.
So these are best estimates. I don't know. We don't have these mortgages. These products aren't available yet. The 50-year mortgage isn't really available yet. So we won't know until we really see them. But we're basing these on assumptions here. So we have a $250,000 purchase price. For the 30-year loan, we have an interest rate of 6%. That equates to a monthly payment of $1,498.88. So let's figure out what the loan constant is on this. So what we're going to do is we're going to take that $1,498.88. We're going to annualize that. So annually, our principal and interest on that $250,000 30-year loan is going to be $17,986.56. So what we do with the loan constant is we take that annualized amount that we're paying in PI and principal and interest, and we're going to divide that by the loan amount. That's going to give us a percentage. The loan constant on that is 7.2%. All right, remember that number, 7.2.
Got it.
Now let's look at the 50-year. The 50-year loan at 6.5% on $250,000. The monthly payment on that, principal and interest, is 1409.29. So now we annualize that, and that becomes $16,911.48 annualized. That's what we're going to pay every year towards this 50-year mortgage. Our loan constant, we divide that 16,911.48 by $250,000. That gives us 6.7% loan constant.
6.7 versus 7.2.
Right. So what's the difference here? We've got a half a point percentage difference. So right off the bat, I can tell you that the 50-year mortgage, having that lower loan constant, if we look at it from the perspective of a real estate investor, or a creative real estate investor, someone who's going to go out and take that loan subject to, that loan is the cheaper loan for us. That means increased cash flow for us. All right. So we have a loan constant difference of, well, it's roughly 0.4%. It's a little bit over 0.4%. I just rounded it off. This equates to, what does this all equate to? We have a cash savings annually of $1,075.08. Now, that doesn't seem like much, considering the fact that almost none of that, maybe pennies of that, is actually going towards principal.
Principal, right.
All right. So, nevertheless, it's a cheaper loan for us. If we take it subject to, it's a cheaper loan. It's going to cost us less. It's actually going to earn us more per month than the 30-year mortgage would, to the tune of $89.59. Now, that doesn't seem like a lot. That's $100 a month. $100 a month is what assuming that our terms, when we turn around and sell or finance that, assuming that our terms are structured correctly, we have the potential to earn another $100 a month. And that doesn't sound like a lot. And annualized, I said it was 1,075. So doesn't sound like a really great deal, but let's stretch that out. Let's stretch that out over, over the course of, and by the way, if you were to take one of these 50-year loans as a creative subject to real estate investor, you have got to go into this with the mindset that and the discipline that you can weather these crazy ups and downs in real estate, because a lot of people are relying on this appreciation. And I'm here to tell you, like we saw 2008, all the home values got wiped out. Nevertheless, and that's when people started to freak out. They became over leveraged and
Yep.
they just, but if you have from my point of view, I'm a long-term buy and hold guy. So if and rents are not going down. So from my point of view, you have to go into this as with the mindset of this property you've taken subject to, you have to hold on to this thing forever, for as long as you possibly can, in order to realize any of these benefits. Now, let's combine this with, let's throw a wrench in this whole thing. No minimum credit score required on Fannie backed loans, which
we've learned nothing.
We've learned zero.
Hey, we're just that friggin' stupid.
We've learned zero. Now that's really, really bad news, I think, for the market. But again, glass half full guy here. That to me presents opportunity in the future, and this is where I think this mindset of going into this long term, you have to have you. This isn't quick money. This isn't get rich quick at all, ever. So yes, they've removed. This is actually in the policies in place today. They have removed the minimum on Fannie and Freddie backed loans. They've removed that minimum credit score requirement. So, in short, I think my advice would be on this is, I've already said it once: long term outlook, but be I think right now is the time we need to start really looking at, or paying attention to rather, some of these loan defaults. Today marks the day that we have got to start looking at loan default rates. This is going to drive everything, because this is going to drive everything down to your marketing. We've always marketed for pre foreclosures, and we've had the lowest pre foreclosure inventories in history in recent years. So, um, but I do think that we're going to start, within the next 5 years, I think we're going to start seeing some defaults, because obviously these are now subprime mortgages. Really, that's what this equates to. This
Yes.
equates to unqualified people getting mortgages that they can't afford. You trying to tell me that that the $89.59 per month that they're going to save on a 50-year mortgage for a $250,000 home is going to be the saving grace to prevent a default? It's not. So,
Not. Can I say a couple of things
yep.
about that first? So you've hit the nail on the head. When you remove a minimum credit score of 620, which is interesting because we're doing a seller finance deal on a guy that had a credit score of 602. So
I
we
thought it
did
was 640.
no.
Oh,
We did that, but we vetted a variety of other things, which I'm sure because I'm a government incompetence guy. The government's never met anything they haven't screwed up. So I'm sure when you remove that minimum 620 credit score, like they don't have 16 other factors in place to make sure that we don't have defaults. So what you said is exactly right. Common sense says that there's going to be more defaults. Can I just state for the record too that the defaults on current loans over the past 3 years has increased dramatically.
mhm.
Why? Because people can't, because of inflation,
Yeah,
right? People can't make their monthly payments. The banks have not started the foreclosures process.
yep.
The banks have not started the foreclosure process. Well, they probably started with the notices, but they've not actually are in a position to force the properties into the auction sale, right? Depending on, your particular state. Yeah, but there are a lot of defaults that already exist. And you're correct. It's now going to get worse. Seems like it's strategically designed to get
Think?
worse
You
almost,
think?
because when the market, we call it a crash, it's not really a crash, it's an adjustment. When the market adjusts down, the housing prices across the country are overinflated. That's a fact, right? So what do you do to get that down? Well, you kind of have to artificially cause the adjustment, right?
Fabricate something.
Not a crash like, oh wait, that was a crash, but you're trying to create the adjustment. So that's really what's going on here. I think is that they're trying to create the adjustment. And what you said is so perfect. The creative real estate people need to be ready to jump on, especially the subject to,
Yep.
right? Let's get it out of foreclosure and get especially the subject to rates. And you're so right. Who cares if it's a 50-year mortgage? All that means is better cash flow for me because I can sell or finance it in 30 years, right?
Yep.
I can still do a 30. I can do whatever I want really. I can match it at 50. I can do 40 and come out ahead. I can do 30 years, right? And enhance my cash flow in the month to month, depending on how I amortize that to my end buyer, right? And particular terms and circumstances. So, yes, when you look at it, it says, okay, this seems a little silly. Taking that out seems a little silly, but why is it being done? So hopefully we have a little understanding about why is it being done and how can we benefit as real estate investors and use it, especially like you said, creatively.
Yeah. Now, I don't want to. I don't want to uh, sit here and present this fantasy idea that all these 50-year mortgages are. Let's just start going after these 50-year mortgages,
Yeah, no. Yeah.
because you got to understand too. Um, like you said, this devaluation, or this, I don't want to know if I want to call it a crash yet, but this
Market correction.
this market correction, this bubble that is being created right now, um, I do think that the values of those homes are going to depreciate. This is why I'm saying you have to be in this for the long term. You must be. Um, so if you need cash quick, this is not the strategy for you. This is
Yeah.
not it.
Yeah.
Because they will correct back up eventually. It's just going to take a long time to do it. I mean, we've got to this point now. From the 2008 2009 stuff, it's taken us a long time to do it. I mean, literally, that's the mindset you have to have. Like, what's going to happen in 10, 15 years? Um, but I do think so. My point here is that you still must vet the deal. The deal still has got to be a deal. You can't just take it because you can take it, or because it's there for the taking, and because someone's willing to, well, someone's so desperate that they're willing to uh, give you their let you take their property subject to. It's just not. It's not why. That's a common. It's common phrasing, and that's something that we tell all of our students, and we've actually told students before, like, one of our favorite things to say is, this is a situation where you've got a super motivated seller, but the deal just is not a good deal. And just because you can take it subject to does not mean that you should, because it's still a bad deal. So you have to vet these deals thoroughly.
Yep.
Uh, but I think a lot of them, yeah, I couldn't give you a percentage really, but I think a lot of them, if you go into it with the attitude that you're you're going to die by the sword. You're going in and you're thinking about this long term. You're thinking about it like an actual investment versus some kind of uh, get rich quick thing. Um, you that's definitely I guess I want to say a hedge. That would be a hedge. If just the mindset alone would be a hedge into preventing yourself from getting in trouble.
Yep.
So
And I'd like to always keep in mind too, everybody needs some place to live.
yeah,
So even when the market goes down for whatever reason, everybody still needs a place to live,
Mhm.
right? So you have to keep that in mind. Like you said, if you're a buy and hold long term investor, if you're a fix and flip guy, right? Maybe getting a subject to fix and flip can lower your costs and do all that. But
yeah,
fixing and flipping might not be so great here coming up when the
yeah,
market, we'll just say when the market corrects.
yeah,
Like there's a lot of stuff being done to force a market correction. Do not be fooled.
yeah,
There is a lot of things being done to force a market correction.
yeah.
Be ready.
Yeah, I mean, these are the cycles that we're talking about. Like, um, this is why when I think also, well, you can always, I think, through any kind of correction, there's always the opportunity to be a buy and hold investor. It's kind of like the de facto standard that you can always find a good deal. Really, maybe always is not correct, but if it seems like you can always find a good deal really in any market. Um, it's not true for flippers. You
Yeah.
have to pay attention to the cycles. You really, really do. And I think we're entering into, like, we had this big boom. How many flips have we done in the
Yep.
past? And
A couple of years. Yeah. Yeah.
and there's been, I've done it with other business partners and stuff. And obviously, it's because of this appreciation. Well, I keep wanting to say appreciation in home values, but that's not the case. It's because we've got more dollars in the system, and now those homes demand more dollars, so it makes more sense to flip. But now I think, provided this policy change is actually implemented, I think it's going to put us, uh, and continued inflation. Obviously, it's going to put us in this little this downward spiral. And I think you have to start thinking about the opportunities that are coming along with that. So,
Yeah,
uh,
especially with, as you mentioned, it's the defaults. So whether the 50-year term comes into play widespread or not, the defaults are certainly going to go up because of the removal of the minimum credit score.
certainly,
100%.
yeah,
So you have to be ready and creative. And so what we try to suggest you do is like have tools in your toolbox. knowing how to properly use the 50-year mortgage to your advantage as an investor is a tool in the toolbox. It's just another tool to use. Like when we sell our finance deals, maybe we'll contract for deed, or maybe we'll write mortgage it. Right? There's different tools to use depending on what you want to do as your end exit. The particular deal and your particular end buyer dictates all of that, right? How all that pans out and what you want to do and how you want to do it. So you have to be ready for that, right? You also don't let, just because the Fannie Mae is removing their minimum credit score, that doesn't mean you have to as a seller finance guy, right?
Right.
That doesn't mean you have to. You still have to vet your people properly
Yeah.
and do the right things, right? So
Especially if
that
you're thinking long term.
right,
Yeah.
absolutely.
Yeah. Um, I don't know. What did we miss anything here?
I don't think so. Other than that, we missed our shameless plug, so let me do that one real quick too. So like we do this all the time. Sometimes it just seems like so natural to us to do things because we do it all the time. We've been doing it right, and we have our students that we help with, our partners, our deal partners. But like if you want to come in and do it, especially if the market's starting to go down, like that's when you really need somebody by your side to help you. Like that's not really the best time to come in as a new real estate investor and try to figure it out, right? That's really when you need support and people you can partner with. So that's
Let,
why we have the deal partner
and
program.
let me point out something as well. This coming correction um, might not be the best opportunity. I mean, I don't know how many people you know. I know a lot of people that had that went out and was buying, with paying cash for these properties and using hard money and all this expensive money. And now you've got a bunch of hard money lenders that, or had a bunch of hard money lenders that were stuck with properties. Um, and so my point is really understanding uh, what to look out for. If you're not in the game right now, if you haven't been following us and you haven't been looking into creative financing, I think preparing yourself today for what is coming, not to scare anyone. This is not to scare anyone because it's
Yeah,
happening. It's
yeah, yeah.
happening. It's starting. It's starting right now.
It's just a market cycle, like you mentioned.
Nothing you
So
can
you
do
have to
about
be
it.
there. Yep.
Yep. Nothing you can do about it except for adapt to it and look at the opportunity that you have when this comes. Um, you're going to see some. You're going to see some. I think some. There's going to be a little bit of sadness with it. I mean, obviously, nobody likes to see people harmed and financially or otherwise, but you do have an opportunity to help these folks. You really, really do. And I think now would be a really, really smart time if you're not into this yet, or if you've been on the fence about it. Um, I think you really, really should consider getting some help with it. I really do. So, those of you out there that watch this now or watch this later, scan that QR code. Um, Give us a shout. We'll talk to you about it, and if it's for you, then we'll get you coached up on it.
Yep. And also too, shameless last shameless plug of the day too. If you're interested in getting into real estate investing, right? But maybe actually dealing with the properties themselves and all that, maybe you're a little reluctant to do that, maybe you don't have the time. We also have our own fund, right? Again, we're creating this whole ecosystem here, like this turnkey ecosystem. So we have our own fund. Here's the fund page. We're seeking accredited investors now, so that's another way that you can profit from real estate investing, right? Because
Yep.
we as experienced creative guys now have a fund that we use to help navigate these situations for our students and profit from that, right? Win-win-win situations. That's what we endeavor to do. That's what we do in our deal partner program, or that's what we do in our fund. So there's two different ways you could go, right? Or if you're a deal partner with us as a student, then the fund will benefit you ultimately anyway because you can use us to help fund your deals.
Yeah. And by the way, if you don't know what an accredited investor is, don't freak out. A lot of people think they're not accredited
Oh,
investors. I can tell you,
yeah.
I would be considered an accredited investor based upon the assets that my company holds. So
Yep.
it's not cash in the bank. It's net worth. Okay. So,
Yes.
and there's a bunch of different categories of accredited investor. Just take a picture of that QR code. Go out there and take a look at what qualifies you as an accredited investor. It can be anything from you have an LLC with over $1 million in assets, which is not hard to do if you're in real estate. It's not hard to do at all to
Yep.
have $1 million in
Yep.
assets.
Three rental properties, and you're probably at $1 million.
It can be a you have, maybe you don't personally don't have that kind of net worth, but you have a trust that has all of your assets in it. Don't let the term accredited investor scare you.
Yep.
A lot of people that qualify as an accredited investor that simply don't realize that they meet that qualification. So yeah, take a picture of the QR code, go out, check it out. And if you qualify and you're interested in not what do you say, not taking care of tenants, toilets, and trash.
Yeah. Yes. If you don't want, and especially you don't have the time, like you can still, like, you want to diversify no matter what. If you're an investor in any way, shape, or form, you want to diversify yourself. And don't think when the real estate market bubble that it's correction that's being forced. Hey, by the way, that's going to make the stock market go down.
Yeah.
So,
And
right, diversify your money, brother. Like, buy gold and silver too. Like, diversify.
and
In
by
all
the
things.
way, that stock market, you're not getting any of that money back.
Yep.
Likely, it's just
Yeah,
gone.
you got to wait 10 years before you can get back to where you were, right?
Yeah. Real estate is at the very least worst case scenario, worst case scenario, you have a hard asset that you can sell and at least recover something. If you're in the market with paper, boy, it is nerve wracking. It is and that's why I love the real estate game, because I know that worst case scenario, I might take a loss. If we have a serious correction, I might take a loss, but I've got something. There's something there. There's some tangible asset that I have that is of value. I will get something back out of that asset.
Yeah.
So
It would be shocking if that was a 30 or 40% loss, like your paper assets in the stock market are.
right,
It might
correct.
be a 10, maybe 15, 20% in a worst case scenario, but usually it's much less, even if you do have to take a loss for some reason.
Right. Okay. Anything else?
I think that's it. I would just say have a great weekend, and we'll be back at it next Friday.
Awesome, man. You guys have a good one. We'll see you. See you next week.